Hey everyone, welcome back to the Daily Gold Podcast. Today we're chatting again with Greg Weldon of Weldon Financial. He's an author, commodity trading advisor, and a former trader himself who now publishes research for both the institutional and retail crowd. Greg, first thing I want to know, we had that super strong move in precious metals in August and September, and as you know, the seasonality, while we're in the larger picture, we're in a very bullish time frame for the seasonality. October always tends to be weak. So given that and given that we're kind of overbought here, is that why we're seeing a little bit of a pullback in the precious metals complex, or is there another reason you attribute that to?
That could be part of the reason. Certainly the October seasonal ties in time-wise with the election here in the U.S. We got the move from the Fed to buy agency mortgage-backed securities. That was seen as a less political move than buying treasuries, but they left the door open for purchases of treasuries. If you look at the net monthly accumulation, they left it open-ended, but they defined the monthly purchases of agency MBS at $40 billion a month. When you look at QE3, it ran out at about $92 billion a month in net expansion in the balance sheet. So this, QE2 did. So QE3, therefore, is less than half that. And comments that we've seen subsequent in media interviews from several Fed members clearly implies that they are more than willing to admit the door is open to further purchases of treasuries. That becomes a necessity because there's a lot of treasuries that mature in the next 3 months, 7 months, and 12 months. If you get a push higher in interest rates, that's problematic as it relates to the U.S. budget situation. So there's a lot to think about. But the bottom line is, from a timing perspective, we had anticipated a rally up towards the 1800 to 1805 area in gold. We kind of got it. You do look at a seasonal week period. You do look at November elections and increasing uncertainty in the next couple of weeks. And given the degree of the move that we've seen from roughly 1600 or below, you could see a corrective move here as something that could be seen in the normal, scheme of things without disrupting, the tenor of this bull move.
Greg, last time we talked, you mentioned, coming up in the next couple of years, there's all that debt that has to be rolled over. Is that why the Fed announced open-ended QE, or is there another reason for that?
I think that's part of the reason for sure. I think that when you look at what's happening in Europe, when you look at the programs that they've brought to the table so far, they had to do something a little bit more creative, a little bit more shock and awe-ish, and leaving it open-ended certainly gives them that without really committing to anything. So I think there's a stroke of brilliance behind that move. Moreover, setting a low bar for the initial phase of this program, which over 12 months would accumulate $480 billion of agency MBS. We know there's size limitations just in the MBS market itself in terms of its depth. And again, the whole purpose of this is to point to the fact that not only is it open-ended, but the Fed has really, left the door open for an intensification of the pace of buying, which to me is much more important. There's another dynamic to be mentioned here, too, in the context of, we know that the housing and labor markets, while there may have been some seeming improvement, at least in the headlines as it relates to employment and in the underlying fundamentals in housing, you're not going to get wealth reflation in housing. You're not going to get income reflation in the labor market, which kind of does leave the stock market as a focus. But the bottom line is we know that the labor market and the housing market, the real economy, not fixed, can't afford higher interest rates for sure. And you have the interest cost on the federal budget, which, in 2011, just the interest cost alone was a record high at almost $500 billion. And this is with record low interest rates. So imagine what the interest cost dynamic would do if bond yields actually rose. That would be highly problematic. So, there's a variety of reasons to think that the Fed will be back in play in a more aggressive way down the road. But, in terms of buying treasuries, it is a political issue. And with the election here before us, it's tough for them to move, in the next 6 to 8 weeks. So it does create a time window. But longer term, for sure, it's open-ended because they know it's going to need to be open-ended.
Just a quick follow-up. So when you're talking about down the road, you mean maybe this winter or next spring?
Yes, I mean I think you have some kind of potential. I don't want to call it crisis, but you're going to have a push point in the bond market, I believe. And especially if people want to grab onto numbers like we got today in the labor market, and it suggests that they're, decidedly positive, and they're going to push bond prices down as a result of that thought process, which to me is faulty to begin with. I could dissect this employment number in 5 minutes and shred it and really show that it's not nearly as strong. But I think people accept that, and I think people realize what's going on there. They're not fooled. But yes, I would pinpoint a time frame for some kind of push in the bond market that causes a Fed reaction, that does provide another catalyst to the upside in another leg in the bull moving gold, as something that probably happens between now, really, I would say December on into April, May, something like that.
Let's move over to Europe for a minute, because gold priced in euros, I'm sure you're very well aware, has broken out to a new all-time high. What do you think are the fundamentals behind that?
Well, I think that it's tricky. We've liked it because you have to like it. Technically, it has been an outperformer. And, certainly if you look at what the ECB President Mario Draghi has been able to accomplish, you have to be impressed. He has, generated the second largest decline, 13-week decline in European bond yields ever. And to basically facilitate that, he had to do nothing. He did nothing. He talked. He pledged. He used rhetoric. He, unveiled the bazooka, but he didn't fire it. So, having gotten that bang for the buck without actually having done anything is impressive to say the least. So, from that perspective, the bang for the buck that he got in bond yields did warrant the move in gold and euro. Having said that, is the ECB actually ready to monetize sovereign debt to the point where it debases the currency? That remains to be seen. It's a major question mark. It goes in line with the timing here of the U.S. election to suggest that from the move from 1,600 to 1,800 in dollar terms and the move to new highs above 1,300 euro in euro terms, does intensify the risk dynamic as it relates to buying gold right here, for sure.
Could you just follow up on what you mean by the risk dynamic?
Well, it's pretty simple. If your downside risk, in buying gold at 1650 was $100, your downside gold, in buying at 1800 is, $100 plus the $200 that's moved. Now that's a slight exaggeration because you could certainly pick, a new downside, stop loss pivot point for a bullish position. But the point is, you've moved a lot, $150 to $200 in dollar terms. On the basis of the Fed move, on the predication that the ECB has promised to do something, from here, the risk is if they don't do it, and if the Fed doesn't, push into the Treasury market as well, you could be, in for some downside corrective moves. Now, having said that, you've seen a lot of short covering. You don't really have speculators loaded up on the long side like you have in the past. It's not like the risk is prohibitive here. But understand the risk is a lot higher right now than it was just 4 to 6 weeks ago.
So, essentially it sounds like you're waiting for this market to, regarding the equities and the metals, to kind of digest the move that they've had. It's a very strong move, very strong momentum readings, at least on my screen, and, a typical overbought condition. And, it looks to me like they're just kind of in a digestion process. Would you agree with that?
Well, I think you could say that over the last, say, 8 to 10 days, yes. But, from our perspective, and even within the context of the conversations you and I have had, we have been long gold. So it's not a question of, am I going to buy it here? I'm already long, so I don't have to make that decision. That's a tough call. Do you buy it here at 1770, with an outside, downside reversal day on a Friday after making a new high with all of the risk considerations we're talking about? I think, that's a wait-and-see attitude. Given the fact that we're long from roughly 16 and a quarter, it's a lot easier just to hold on to it here and not have to worry about it. So, it really becomes a function of your perspective from, your own little position dynamic. If you're not involved, I'm probably going to wait for a dip to buy it, yeah. But, luckily for me, that's a really hard play to make, and I'm glad that, for me and for my clients, we don't have to make it. We're already involved at, fairly advantageous prices.
Right. Now, next, let's get a few of your thoughts on the economy. Because obviously the S&P is broken out to new highs, new recovery highs since we last chatted. Some gold bugs may be a little bit worried about the near-term correlation of precious metals in the S&P. I mean, what's your read on that situation? Is that something that worries you, given maybe the concern about the economy possibly falling back into recession?
Yeah, it absolutely worries me. In fact, it's worried me for quite some time. But having said that, I also think there is a point in time that is fast approaching where gold will diverge from equities. The correlation certainly has tightened considerably in the last 3 to 5 years for obvious reasons, because now it's an asset price reflation, not just a gold price, not just a stock price, not even just a bond price. It's an asset price reflation that touches all asset classes in the capital markets. Because they print trillions of dollars that are not being used by the bank to lend money. It's not being used by the real economy. So, of course, it goes into the markets, and we've seen that. The Fed's okay with that. Yes, I worry about gold from the perspective, is the stock market, riding a wave of hope that may or may not be fulfilled? Certainly, it's not riding a strong economy. There's no doubt that asset markets are completely disconnected from the realities as presented by the macroeconomic data that applies not only here but everywhere. But that's not what's driving stock and asset and commodity and gold prices right now. It's purely a function of monetary policy, debt monetization, and debasement of currencies. We see that in the fact that gold is broken out in almost every currency term. But I do believe that you could reach a point where you get, a reality check in equities that react to the negativity in the global economy that actually causes gold to maybe rally more, and you get a disconnect in that correlation that has tightened so much to where there's really people are pulling out of bonds, pulling out of stocks, and gold gets favor from that perspective, where it's a little more of a concern, panic, anxiety over the degree of erosion in the real economy, and of course then the next phase of that thought process is, if you continue to see erosion in the real economy, it will push the central banks to act more aggressively, and that would be positive for gold as well.
Greg, let me get your thoughts on China and India in the near term, as far as they're having a positive or negative impact on the gold market. Maybe something I want to mention: India's stock market has really been outperforming the last couple months. Does that have any positive implication for gold?
It does. Certainly some of that's been linked to the moves in the currency, which has, gold and rupee was one of the first ones to break out quite some time ago. In fact, on the weakness of the rupee, and then you threw in the breakout in the gold, and you have a real story there. So yes, it's absolutely a positive. You do wonder at what price does it become a little more prohibitive for the average, Indian to be, continuing to accumulate gold. We see that, stock markets, there are other stock markets in Asia that are in the same vein. Thailand's a good example, at a new all-time high here. So you do see signs of that, and really what that is also kind of symptomatic of the same thing we're talking about, all around. I mean, Thailand stock market's outperforming on the basis of its emerging market and, commodity export-linked dynamic. But there, too, you see problems from that perspective with the underlying real economies. We see it in India, we see it in China, we see it in Thailand. So, again, it's back on the central banks. Central banks, this is why you see Chinese markets kind of lagging. Their central bank is behind the curve. Other central banks are not so far behind the curve. And other central banks, have room to move. In the case of Korea, Thailand, two good examples. Where they have room to move, where interest rates, they raised rates enough to where they have some gunpowder. So I look at that generally, that entire dynamic, Asia and what the markets there are telling us right now as being more positive than negative. If central banks were to become more aggressive, which I think they will, that should exacerbate that bullishness in terms of gold in those currencies.
And before we close, Greg, do you have any final thoughts on anything that we didn't discuss?
Sure. So many variety of things. I think that, it really, to me, again, I get back to very, very closely watching the gold S&P ratio. I think, it was a very good question that you brought to the table. It's a really key thing to watch. The two things that I find most important: U.S. bond market, 30-year bond and yield curve, and then, the stock bond ratio. So keying off those things, if you see a disconnect and a continued rally in gold versus the S&P, particularly if, bond prices start to come off, that can be really bullish for gold. You could get a situation here where bond yields start to rise. You have a lot of money invested in bonds. You want to talk bubbles. People always, I get asked a lot, is this, a bubble in gold? Is there a bubble in gold coming? Is this a bubble in equities based on, the disconnect with the macro realities? And, clearly enough people also ask the question, is this a bubble in bonds? And certainly you could make that case in the U.S. If we get a push higher in yields that's predicated upon a large degree of supply, big public borrowing. I mean, the most recent U.S. deficit, the budget deficit for August, a record spending in the month of August. This cannot continue. This is what's just mind-blowing to me is, the current U.S. administration is getting away with murder on the spending side, while they talk about, first, we don't have a budget, and, we're talking about austerity and, all of the things that they're talking about doing to bring the deficit down. They're not doing any of it. And in fact, it's moving in the opposite direction. Record, all-time, single highest month of spending in the U.S. history in this past August, most recent budget numbers. That's a problem. The bond market's a potential problem. We'll bring the Fed back into play, but I think that means bullish for gold down the pike. So to me, if I leave you off with any takeaway, it is if you do get a kind of rise in bond yields and a little bit of a disappointment in asset prices that the macro realities are not going to benefit from this, and that the ECB may be slower to act than they were to talk, that dip is probably to be bought, and to be bought pretty aggressively, because down the road, you're going to have a bond market problem in the U.S., and the Fed's probably going to respond to that very aggressively.
Okay, Greg. Now, before I let you go, can you tell our listeners how they can sign up for a trial to one of your services?
Sure. We offer your listeners a free trial, 30-day trial to any of our research products. The Money Monitor is our flagship product. Talks about anything and everything. We've also just recently introduced what we call the Trade Lab, which off the Money Monitor and off of our quantitative work provides specific trading recommendations with futures markets, bonds, currencies, global stock indexes, and ETFs. So it's pretty much anyone can use it. The Metal Monitor is a gold and silver product. It's an audio-visual report that we do once a week with quantitative work on a daily basis. And we also operate as a CTA in the U.S., a commodity trading advisor with a Series 3 license. So we have managed accounts, commodity-specific, and our newest metals-only program, which is a smaller minimum and seeks to capitalize on the volatility, both up and down, that we see now and anticipate seeing for the foreseeable future in the precious and industrial metal sectors. And that all can be found at www.weldononline.com.
Okay, Greg. Well, thank you so much for coming back today. I really appreciate it, and hope you have a great weekend.
That was my pleasure, Jordan. Take care.